Welcome to today's daily brief on the financial markets. I am so thrilled to have you here for this explainer, because today we're diving deep into the actual mechanics of price action. We are going to break down exactly how seasoned professional investors are trading one of the absolute hottest sectors on the market right now, cybersecurity. We're cutting through all the noise to look at the raw structural maneuvers that separate the smart money from the amateurs. Let's jump right in.
Here's a quick roadmap for what we're covering today. We'll start with the cybersecurity boom, look at the obvious breakout trap, learn how to spot a market shakeout, dive into some real examples with CRW and FTNT, analyze the broader sector ETF, and finally, talk about conquering the trading brain.
All right, Section 1, the cybersecurity sector boom, and the massive macro tailwinds driving this exponential growth. Now, we aren't just throwing around buzzwords here. The cybersecurity sector has an undeniably massive tailwind at its back right now, and it's being driven by two distinct technological revolutions. First up, we have the rapid integration of artificial intelligence, and second, the looming inevitable reality of post-quantum computing. These aren't just minor updates. These advancements are fundamentally changing how digital security operates. They're literally forcing corporations worldwide to massively upgrade their defenses. It's a true structural shift in global tech.
And to put that into perspective, because of those two specific drivers, total sector revenues are projected to double over the next 7 to 8 years. That's a 2x multiple. I mean, that is a staggering amount of capital flowing into a single industry. The fundamentals are incredibly strong, and the structure is undeniably bullish. But, and this is absolutely crucial, strong fundamentals do not mean you just blindly smash the buy button.
Which brings us to Section 2, the obvious breakout trap, and why retail investors constantly get shaken out.
Let's make sure we're on the same page by defining exactly what we're dealing with here. A false breakout is a sudden price movement through a defined support or resistance level that quickly reverses course, trapping amateur traders on the wrong side of the market. And listen, this isn't some random accident. It is a deliberate, engineered mechanism used by the market to generate liquidity.
This brilliantly highlights the massive divide between two different types of market participants. Over on the left, you've got the amateur move. The amateur sees that resistance level break, they feel that intense FOMO, fear of missing out, and they just buy immediately. They get hooked. But on the right, you have the professional move. The pros know the fundamentals are good, sure, but they manage risk above all else. They wait patiently for the price to inevitably drop and hunt for stop losses before they ever risk a single dime.
So, moving to Section 3, spotting the market shakeout. Let's look at the actual anatomy of a structural market trap.
It's really a three-step playbook. Step 1, the initial breakout triggers a wave of retail buying. Everyone rushes in. Step 2, the market reverses and the price drops intentionally below a previous support level. Why? Simply to hunt stop losses and shake out the weak hands. Step 3, once those weak hands are forced to sell, the strong hands, the big institutional money, step in and buy that dip with incredibly high volume, absorbing all that panic-sold stock.
Now, you know what a stop loss is, right? It's that automatic order you place with your broker to sell a stock once it hits a certain price, mostly to limit your downside. While stop losses are absolutely vital for managing your risk, you have to realize that this entire trap strategy relies precisely on knowing where amateur stop losses are clustered. And where are they clustered? Right below obvious support levels. That is exactly where the smart money goes hunting.
Section 4, let's look at some real, live market evidence using CrowdStrike and Fortinet.
You can see this mechanism perfectly in CrowdStrike. Back on May 26, we had resistance sitting at 169.37. The price broke through and bam, the amateurs bought the breakout. The very next day, May 27th, a support baseline was established at 158.27. So what happened on June 9th? The price didn't just casually drift lower, it was systematically pushed down to a specific shakeout low of 154.44. It deliberately broke that May 27 support to trigger all those stops. It was a total calculated sweep.
And what happened right after that sweep? Once the stops were hit and the retail traders were totally shaken out, massive institutional volume flooded into CrowdStrike right around the 170 level. We saw the trading volume bars expand significantly. That aggressive, high-volume expansion, that was your clear, undeniable confirmation that the professionals were entering the chat.
We saw the exact same engineer manipulation happen with Fortinet, which was showing a continuation triangle pattern. But Fortinet was wild. It didn't just have one trap, it had two distinct ones. Trap number 1 formed support on June 2nd at 141.79, only to be shaken out on June 9th.
Then, it sets up a new support on June 12th at 142.16, which gets brutally shaken out again on June 18th. They cleaned out the buyers twice to make sure the book was completely clean before the real breakout finally launched on June 25th. If there's no trap, they just don't buy.
All right, Section 5, Analyzing the Sector ETF. Let's see how these rules apply to the CBR Cybersecurity ETF.
It turns out, this structural manipulation isn't just happening to individual stocks, it's perfectly visible at the macroeconomic ETF level too. We had a strong overall uptrend, and the May 27th support baseline was set at 81.74. Right on schedule, on June 9th, the price drops to 81.51. It pierced that support just enough to trigger widespread panic and sweep the stops. And immediately after, a massive recovery, a gap up, and a huge surge in volume. The footprint of the smart money is exactly the same, whether you're looking at a single stock or a massive sector ETF.
Finally, Section 6, Conquering the Trading Brain. Let's dive into the psychology of risk.
I want you to honestly ask yourself for a second. Why does your brain completely panic when a trade goes wrong? When a position instantly moves against you, you literally feel it physically, don't you? Your heart rate spikes, your stomach drops. Why does a little red number on a screen cause such a visceral, biological reaction?
Well, this quote really hits the nail on the head. Our human brains just don't come factory installed with the software to trade financial markets. When you face an unexpected monetary loss, your brain literally processes it as a life-or-death physical threat. It genuinely considers this financial threat like a tiger or a lion coming out of the bushes to eat you. It triggers a primitive panic response. You stop thinking rationally, and you just start acting on pure survival instinct.
And that brings us to the ultimate comparison. The untrained human brain makes about 90% of its decisions purely on emotion and panic during these market shakeouts. And trust me, the market makers know this. They rely on it. Contrast that with the systematic playbook. A proper system relies entirely on defined risk-reward rules and strict stop losses. It completely neutralizes that lion response. If your system triggers a stop loss, you execute it mechanically. No emotion, no hesitation. You manage the risk because you understand the market is a game of probabilities, not certainties.
So if you take one single thing away from this explainer today, let it be this core philosophy. If there is no trap, do not buy. Wait for the shakeout. Patience is quite literally your ultimate edge. You wait for the market to do its dirty work, clear out the emotional amateurs, and only then do you align your capital with the institution stepping in with heavy volume.
Which leaves me with a question for you to chew on as you look at your own portfolio. Are you trading with a systematic edge, patiently waiting for those engineered traps? Or are you just waiting to be shaken out by the next market lion? Thank you so much for joining me for today's explainer. Stay disciplined out there, and I will see you next time.